Hello, this is Jeff Bish, president of MarketGauge.com, filling in for Keith this week to do the Market Outlook. I'd like to remind you to please vote down below. Give us your bullish or bearish opinion with a simple click, and then we'll be able to send you the results in the middle of the week. So this week was pretty much a lot of nothing as far as the analysis goes. I'm not going to try and overanalyze any of the charts, but let's just go through and look at them from a perspective of, are we in a position for an up move or a down move? And I'm going to look at that from the perspective of our standard charts, and then we're going to take a quick trip around the world to see if we can get a sense of whether or not there is an appetite for equities just by looking at the charts. Because the question that is on the top of everybody's mind here in the U.S. is fiscal cliff. And there's a lot of talk, I don't know if it's the prevailing wisdom, but there's a lot of talk about if we could just get a deal, equities could get going, stocks could get going on the upside. If we don't get a deal, it will be disastrous. But meanwhile, the talk of the progress or lack thereof in the talks has not really had a substantial negative effect on the indexes. Now, at some point, markets do tend to just give up and surprise people to the downside. So I'm not in any way implying that just because the markets don't seem to care, other than a quick spike down when either Bonner or the president come on and say something negative, that's not to suggest that we're out of the woods in terms of the downside of the market. But let's take a look at the numbers and look at it from a more objective point of view. So first we're going to take a look at the McClellan oscillator. Now this is what we like to use for a broad view of the market breadth, and from my perspective, you really want to focus on it when it gets to an extreme and the market's moving up. So we're near an extreme here, but you can also see it gets much more extreme. So I don't think there's a whole lot here to read into this, other than the fact that, as I'll talk about in the upcoming charts, the consolidation here, if we break out, we're going to be breaking out at a point where this is likely to get significantly oversold pretty quickly. So the breakout could be, if it happens, a quick one before it starts to consolidate. A healthy situation would be a move higher without getting too overbought in this situation, or continued consolidation, although we've had quite a bit of it, with this moving lower. All right, but we'll get into the technical scenario of the prices above. For now, this is telling us that the breadth is, well, a little bit overbought. It's not an alarmingly overbought level, and certainly not a level at which we would expect to put pressure on the market downward. The VIX, really don't have anything here. We're right in the middle. The market doesn't seem to be overly concerned or overly complacent as far as our measures of the VIX. So I don't have anything there that, again, is going to put undue or extraordinary pressure on the buy side or the sell side based on the VIX indicator. The shorter term 10-day sum of the advanced declines, it's generally a much quicker one than the McClellan and measures it from a different perspective, went from significantly oversold near the lows to significantly overbought at what has now become the recent highs in the S&P over the last couple weeks, and has since come back down, and I would say has come back down enough back into the neutral zone to justify a move higher without worrying about the market breadth again being a substantial negative. That said, a rally from this point would presumably get us overbought pretty quickly. Wouldn't stop me from being bullish, but I have to realize we could get overbought pretty quickly. An even quicker measure of the advanced declines, and in this case also up-down volume. Again, shows you that we've got our overbought reading. We're now working it off, and again, I would say this was overbought. It could easily come back down in. It's a small measure of slightly overbought up here. So far, that's the only one that would still be in significant overbought territory. So from a market breadth point of view, we don't have any alarms going off. All right, one last indicator I keep track of on a longer term basis. If you've seen it when I fill in for Keith, I'll kind of give you a heads up on it. And I think it's something to keep your mind somewhat focused on, and that is the gold-SPY relationship. I mean, essentially, when this indicator goes above the longer-term average here, it's generally a negative environment for stocks. Happened right about here, and you can see the SPYs are basically where they were at the cross, and we're about back down on that level. So, how does this play out? If we see SPYs getting stronger, or I should say stocks getting stronger, gold getting weaker or not getting stronger, that's going to break this down. And that'll give more support for a continued move in equities. So if there's a theme this week for me, the question is, if we move higher, are we in a position where that's sustainable? And here, if we move higher and we don't have a significant move higher along in gold right along with it, then this set of indicators here is saying yes, the environment is generally positive. Okay, now let's take a look at the individual charts and look at the markets from a very straightforward, where are we, support and resistance point of view. The key here is that if we look at all the Market Watch charts, they've got their own version of consolidation, either at, slightly above, or slightly below major moving average, and that in this case is the 50-day simple moving average. The black line is the 200-day. Shorter terms are 10 and 20, but I'm going to really want to focus on the 50, the fact that the downward sloping 50 is being attacked. This week is the first time we've closed over the 50 since, let's go back to almost the beginning of October. So it's not to be taken lightly. However, it's a negatively sloped 50, and you can see why the market's struggling here. It's struggling at its breakdown point from October, late September levels. All right, so we've just rallied back up to some pretty obvious resistance. Now we're consolidating. The overbought situation is getting worked out. The question is, if the SPYs look like they're consolidating for a breakout or a breakdown, right? What do the other indexes look like? Are they going to be supportive? Are they saying the same thing? So let's take a look at the Dow. Now the Dow, the noteworthy point of the Dow is that its consolidation over the last week has now been broken, closed well above, and again closing above its 50-day moving average. So one of the things we're going to want to keep an eye on is whether or not the Dow starts to outperform based on it. Does this breakout of the consolidation give it what it needs to continue to run? That's the question we're going to want to try and answer for all these markets. If they break out, do they have what it takes to continue to run? Because they've all got lots of resistance up above. All right, so Dow again negatively sloped 50, but we're above it. Question is, can it hold? And the key will be, can it hold this breakout level going into next week? IWM, I think, is probably the key index to watch. The larger caps may run without the IWM, but an extended move, I think you're going to want to see the broader market follow it. Would not be surprised, however, if we do see the bigger caps outperform the IWM up into the unknown of the fiscal cliff. So that said, if we can get the IWM going and get it to break out of its level. Now it's closed over the 50 several times. It's also closed over this trend line from the highs, which the other ones have not. However, if we look at the bigger picture on the IWM, it didn't make as much, didn't make as good progress relative to the highs of 11. So its sell-off, I think, is a little deeper. So coming back over the 50, not as much of a hurdle. That said, it's got the same consolidation here, and this is going to lead to a significant move up or down. At this point, I think I'm giving it the benefit of the doubt of saying what are the odds it continues if it breaks to the upside. The fly in the ointment of the upside is the Qs. The Qs really have been the laggard of the group, and that to a large extent is because of Apple. Apple's heavy weighting in the Qs is really weighing on the index. Doesn't mean I'm going to ignore it, but you have to take that into consideration. So the Qs have a messy, at this point, flag-like pattern, still under the 200, under the 50, and well below its October breakdown levels. So the Qs are just holding back the market. Technology, and to a large extent, as I said, that's because Apple is having such a heavy weighting to the downside on the Qs. So going into next week, I'm going to be focusing on the Dow as a potential leader, just from a trading point of view. I want the SPYs to catch up with the Dow, and I want the IWMs to break out of their box. If we can just get the Qs to stop going down, that would be a good start. So let's just take a quick look at some of the interesting sectors that are moving to the upside. And this is part of the reason I would not be surprised to see the larger caps lead. These staples, consumer staples, have taken out their consolidation high. They're extremely close to taking out their 2012 high. So market is running towards these safer stocks, a safer group, and so if this is going to be the leader, well, the markets could continue to move. If they move higher, it seems to be led by stocks that are perceived as a little safer. Along that same line, healthcare, which was enjoying a rather amazing summer-fall rally until the market got hit. But if you see where it got knocked down to, it really got knocked down to its breakout point. And from a 50-200 perspective, this has been a really strong sector. This is one to keep an eye on, because back over a 50 that's actually positive, if not flat, sloped. Got the same box that most of them have, but if this gets going, it's not far from its highs. And as I point out, it's had a strong trend this year, and that strong trend really has not been damaged all that much, especially not relative to the major indexes. Finally, there's the last of the sectors I'll look at, and that's the XLF. And if you'll just notice, my point of reference here is what have the stocks been doing relative to the consolidation over the last couple weeks, and where are they relative to their 50-day moving average. XLFs are above it now, above it for closing above it for 3 days, and a strong day today in the XLF. So this is again encouraging. If you're sensing a kind of a bullish bias to this market outlook, it is because while the bias of the stocks that seem to be moving higher are not exactly stocks that are going to have the market rip-roaring bull market, it's almost feels as though the market has an appetite for what may be perceived as the safer equities. XLF, now to a large extent, this is really being driven by JPM, which I'll pull up, and JPM has had a really nice recovery back over the 50 and going to attack its fall highs as well. So that does have a big weight in the XLF, but we like to see the XLF moving up along with any broad rally. Many would say you're not going to get a broad rally without the XLFs, without your financials. A fly in the ointment there, however, is that KRE, the regionals, in terms of financials, are not nearly as well positioned. In fact, they're almost poor. So if the market starts to get weak and the KREs are leading it on the downside, I'd be a little concerned with that. All right, so all in all, if we pay attention to where we are relative to the 50, where we are relative to the consolidation over the last 2 weeks, that's going to tell you the direction of the market, and you could follow it either way. But I said I would take a look. There's some interesting charts. If we go around and look at some of the other countries and see if there's a theme in terms of the way the global equity markets are set up. Are we ready to move higher? Are we ready to break down? Is there something that just jumps out at us? Now, I won't say that it just jumps out of one direction or the other, but I will say that what does jump out at me is that there are a lot of interesting markets at pretty major inflection points. So let's go just take a look at Europe from the standpoint of Germany, Spain, Italy, and the UK. So here's a ETF for Germany. Again, what I'm looking for is, are we near an inflection? Are the trends shaping up? And the interesting thing here with Germany is that we're at a really significant inflection point. If we can get over this 24 level, that would be pretty significant breakout of consolidation. In fact, let's look at these in terms of the weekly, because I really want to look at the bigger picture. So we've got quite a consolidation and a significant level in this 24 level if Germany can move higher. Now again, the idea here is if the US is moving higher, or does the US is there some underlying support, call it demand or appetite for equities globally? Germany breaking out over 24 would suggest yes in that region. Let's take a look at Spain. Right now, Spain's been a mess, and I wouldn't expect a really nice looking chart out of Spain. But the interesting thing about the chart, and if you saw the reversals webinar we did just recently, this is a very similar situation. Remember, we're looking at a weekly chart here, and I drew in the major area of support. It broke down from it. It's now rallied and consolidating. All right, so this line here is a 50-week moving average. If Spain can get back over this 30 level, is it a big uptrend? Absolutely not. Is it a nice looking bottom formation? Yes, definitely. All right, again, constructive for the bigger picture if it moves higher. If it moves down, then you want to be equally concerned with that, because we've reached these inflection points and they've got the markets have quite a ways they could fall to get back down to the other side of the range. So let's take a look at France. Much like my comments on Germany, we're at a significant inflection point, top of a major range. Again, if it can break out, it would suggest an appetite for equities globally. If we fall back down, no reason to believe we couldn't be back down at the other side of the range, which would be a significant drop. Finally, let's take a look at the UK. All right, same idea, major inflection point. Trend actually here looks more supportive of a potential turn up. Still need to break that level, but if we do, something well worth keeping an eye on. So let's just take a quick look at Asia, and I'll call Asia China and Japan, not to suggest that they are going to move together. Japan's at an interesting spot here. Again, this is the weekly. Has really put in a floor here at this like 890 level, and ceiling up just above where we are. So again, significant consolidation that's going on in a tight way for several months, in a wider way for the entire year, and if we move higher, we break a pretty significant downtrend. I'm not calling for a major bull market in Japan out of this, but is there some reason to believe that any movement to the upside could lead to more movement? Absolutely. All right, quick view of China through the lens of the FXI. I don't see anything really extraordinary here. The only thing is this resistance line has broken, and broken in a very technically neat way, and that could suggest it's got some room to the upside. I think we just want to keep an eye on this. I couldn't talk about the global markets without at least mentioning China. I don't see an inflection point here that is really all that exciting. All right, now finally, there is one chart that is really in great shape, and we've talked about this one in weeks prior. I know I have when I was doing this, and that's our southern friend there, Mexico. Now remember, this is a weekly chart, and that makes this a breakout of the 2007 highs, a really nice breakout. The retracement came down a little bit below, lower than you might want to see it if you were long, but the subsequent rally puts it right back up at all-time highs, and that means this is one of the best looking weekly charts in the world in terms of the indexes that I've looked at. So I want to raise that to your attention. On a daily basis, in terms of trading it, it may need a little bit of a consolidation or a pattern to get in, but keep your eye on Mexico. All right, so with that, I want to thank you for being a part of Market Gauge, and I wish you the best in your trading, and we'll see you in the next webinar or right here at the next Market Outlook next week. Have a good week trading.